Analog Devices delivered a powerhouse third quarter for fiscal year 2026, shattering expectations as the global analog chip leader capitalizes on a robust industry-wide recovery. Headquartered as a primary supplier across industrial, automotive, communications, and consumer markets, the company rode a massive wave of demand for artificial intelligence infrastructure. Chief Executive Officer Vincent Roche highlighted a double beat on both top and bottom lines, driven by accelerating momentum across all major end markets. Beyond cyclical tailwinds, the quarter demonstrated Analog Devices' structural positioning as high-performance analog content becomes increasingly critical to modern computing architectures, automated systems, and next-generation energy networks. For the third quarter ended August 19, 2026, Analog Devices reported record revenue of $4.02 billion, up 40% year-over-year, surpassing Wall Street consensus estimates of $3.91 billion. Adjusted earnings per share reached $3.45, topping the $3.34 forecast. Adjusted gross margin expanded 330 basis points year-over-year to 72.5%, while the book-to-bill ratio remained solidly above 1, reflecting sustained order strength. Performance was strong across all four business segments. The flagship industrial segment generated $1.97 billion, surging 53% year-over-year. Communications revenue soared 84% to $655 million, propelled by exponential growth in artificial intelligence data center deployments. Automotive recorded $998 million, up 16%, and consumer contributed $397 million. Artificial intelligence data center demand stood out as the absolute strongest growth driver across the entire portfolio. The management team addressed analysts on the earnings call to detail the drivers behind this performance. First, Vivek Arya of Bank of America Securities asked about top-line acceleration into fiscal year 2027, the breakdown between secular, cyclical, and pricing drivers, and whether operating leverage remains if revenue grows over 20%. Chief Executive Officer Vincent Roche responded that the company has seen continuous momentum since hitting a bottom in the second quarter of 2024, supported by long-term tailwinds in defense and artificial intelligence. He noted that aerospace, defense, automated test equipment, and data centers now account for 30% of total revenue, with expanding market share across combustion and electric vehicles, as well as high-end consumer devices. Roche added that cost synergies from the Maxim acquisition are on track to hit $700 million this year and cross $1 billion in 2027, providing significant operational leverage as broader market tailwinds lift the whole portfolio. Second, Stacy Raskin of Bernstein Research asked about the communications segment, noting that data center accounts for 80% of the business and is roughly doubling, and sought guidance on near-term and long-term segment growth rates. Investor Relations Head Jeff Ambrosi outlined the fourth quarter midpoint outlook, projecting industrial to grow high single digits, communications to lead around 10% sequentially, consumer to rise high single digits, and automotive to increase low single digits. He explained that long-term strength is driven by double-digit end-market capital expenditure growth and expanding analog bill of materials content, particularly as power systems transition to 800-volt architectures. Roche added that after doubling data center revenue into 2026, Analog Devices sees an extended growth runway for strong double-digit annual increases, lasting through at least 2030, alongside expanding opportunities in the $500 million energy sector. Third, Tore Svanberg of Stifel asked whether the historical high single-digit baseline growth for the analog industry is permanently shifting upward due to artificial intelligence infrastructure and future physical artificial intelligence deployments. Roche replied that double-digit compound annual growth for Analog Devices is entirely achievable for several years to come. He pointed out that between now and 2031, an estimated 100 gigawatts of data center capacity will be built, with each gigawatt representing a $1 billion to $1.5 billion addressable market for analog components. Because engineering challenges around power and signal integrity are becoming vastly more complex, solution sophistication and pricing power are rising, prompting the company to raise its long-term growth outlook well above its previous 5 to 7% targets. Fourth, Mark Lepatches of Evercore drew comparisons to the telecom boom of the late 1990s, asking how today's secular dynamics differ from previous cycles that eventually reverted to historical averages. Roach explained that earlier cycles suffered from extreme customer concentration, whereas today's market is defined by ubiquitous intelligence spread across the edge and information technology networks. He emphasized that as more data and power are processed, the value of specialized analog content increases with every bit and watt. Furthermore, Analog Devices operates with a vastly broader portfolio today, providing operational resiliency and optionality that position the industry for compounding growth over the next quarter century. Fifth, Lane Curtis of Jefferies asked how management frames the multi-year opportunity for automated test equipment alongside data centers within their overall artificial intelligence exposure. Ambrosi clarified that automated test equipment, combined with data center power and optical solutions, represents 20% of total company revenue. He stated that confidence in multi-year growth is backed by strong customer design activity, expanding order pipelines, and robust backlog, rather than mere projections. He emphasized that design momentum remains strong across both semiconductor testing equipment and optical data center architectures. Sixth, Matthew Prisco of Cantor asked about manufacturing capacity, potential supply chain constraints, and when new capital investments might be required to support elevated demand. Chief Financial Officer Richard Puccio responded that internal supply chain execution remains exceptionally strong, supporting 9 consecutive quarters of above-seasonal growth and guiding for a 10th. The company is actively building inventory, expanding internal tool installation, and securing external wafer allocations to manage extending industry lead times. Puccio noted that while order visibility is improving as customers place longer-term commitments, the company is actively scenario planning to add manufacturing capacity if double-digit demand continues. Seventh, Joshua Buhalter of TD Cowen asked whether the 74% gross margin target can be sustained through the cycle and how management balances margin preservation against aggressive growth investments. Puccio affirmed that the company expects to maintain gross margins around 74%, supported by higher factory utilization across the upcycle. He explained that while targeted growth investments and ongoing inflation may create minor margin pressure, a favorable mix shift toward high-margin industrial products provides potential upside. Roach added that the fundamental anchor of their high gross margin structure is the innovation premium customers pay for proprietary high-performance analog technology. Analog Devices is demonstrating a fundamental shift as the analog semiconductor sector emerges from its cyclical trough. Powerful new growth drivers in artificial intelligence infrastructure, high-voltage power management, and intelligent edge systems are expanding the addressable market well beyond historical averages. With record revenue, expanding margins, and multi-year visibility, the company enters the next cycle, positioned as a critical bottleneck for global technology architecture.